If you think Nifty 50 or Sensex are the best indexes or the safest indexes or are the most diversified indexes, this video will completely change your perspective on indices. For a starter, have a look at my screen and what you see is Nifty 50's sectoral allocation. Financial services, one single sector has an allocation of around 36%. Meaning if financial services sector does well, then Nifty will give you good returns. But if financial services does not perform, then Nifty is not going to perform largely. Not only the sectoral allocation, also have a look at top 10 stocks within Nifty 50. And if you add up all these weights, you will arrive at around 55%, meaning 10 stocks within Nifty 50 has 55% allocation. Is this what we call a diversified index? In my view, absolutely not. In fact, Nifty is quite concentrated when it comes to sectors as well as individual stocks. Now, I'm not saying that Nifty 50 or Sensex, these are the bad indices and you should not invest in these indexes. I'm not saying that. My point is very, very simple, that you should not overly rely on just a couple of broad indexes. So in this video, I'm going to speak about 3 indices that you should consider or explore for your portfolio for, let's say, 2030. Although I am a SEBI registered research analyst, I am qualified to talk about equity market. It doesn't mean that you should take this video as a recommendation. Use this video as an education and make some notes. It is going to help you in your financial journey. With that, let me start with index number 1. The name of the index is BSE India Sector Leaders. Now, if you have not heard about this particular index, please do not worry. Give me 3 to 4 minutes of time. I'll explain this in such a simple language that a 10th class boy will understand. We all know what is BSE 500 index. We look at the top 500 stocks listed on the BSE exchange, put them in an index called BSE 500. Now, coming to BSE India Sector Leaders, what this index does is that it looks at every sector of these 500 stocks. Let's say auto is a sector, finance is a sector, IT is a sector, and from each sector it is going to take only the top 3 stocks. How will it decide the top 3 stocks? Simply by market cap, meaning it is only going to include the big stocks, the leader stocks from every sector. Now, as a result of this index strategy, what happens is, have a look at my screen. The allocation of the sector is not very concentrated. For example, BSE India Sector Leaders from a financial services perspective only has an allocation of 13.5% versus BSE 500 that had around 30.4%, highly concentrated. For example, telecom here it is 7% versus BSE 500 only 3.3%. So here BSE India Sector Leader is much more diversified. It caters to almost 20 plus sectors, and yet no single sector has got a very, very high concentration in this particular index. Second key point that you need to understand is that even if you look at the top 3 sectors, in BSE India sector, it is only contributing to 29.3% versus BSE 500 where it is going up to 45%. If you look at the top 3 stocks in BSE India Sector Leader Index, it's only 15.1%, while in BSE 500 it is 17.7%. Meaning, just by using this strategy, we are not having a highly concentrated sectoral or a stock related bets in particular index. Now you will have a natural question, Rahul, what is the use of it if this index has not given us any good returns? So let me now speak about returns, but please note, past returns do not guarantee future returns. But still, let's do a comparison. So what you see on my screen is long-term returns since inception, 15 years, 10 years, 7 years, 5 years, 3 years. In all these time horizons as of September 2025, BSE India Sector Leader Index has comfortably beaten BSE 500. It's only the last 1 year where it has underperformed the BSE 500. But if you look at the long term, definitely this has outperformed BSE 500 comfortably. And also please note, 1 to 2% of extra returns over a longer period of time can really help with compounding. So please do not discount this 1 to 2%. Yeah. Second point, if you see, if I look at the yearly returns, right, going back to almost 19 years, if you see out of 19 years, 12 years, this particular index has comfortably beaten BSE 500. Meaning from an investor returns experience perspective, this particular index has done much better. It has left a sweeter taste in investors' mouth. Why? Because 12 out of 19 years, this has beaten BSE 500 comfortably. Rahul, what about the rolling returns? What about risk-adjusted returns? What about the standard deviation of the volatility? I'm coming to each of that. What you see, if you look at the average rolling returns based on 1 year, 3 year, 5 year, 10 year, this index has done much better. As you can see the data, 16.4% versus 15.9%, so on and so forth. If you look at the standard deviation of the rolling returns, here the standard deviation is lesser than BSE 500. It means it has been less volatile if you look at the rolling return. Last point, return versus risk ratios. If you see, this is still much better than BSE 500. So historically, from all these return related parameters, this has comfortably beaten BSE 500. Therefore, you can comfortably conclude here that past tells us that this index has performed better than the BSE 500. Now let me also bring this index to life to give you some examples of what sort of sectors and what sort of stocks. So look at the top 6 sectors here. Financial services, it includes HDFC, ICICI, State Bank of India. Good combination of private and PSU banks, but it is picking only the top 3 leaders. Remember that. IT, Infosys, TCS, Wipro. Now some of you may say that IT is dead and all. That is your view, okay, right? But the index is looking at each sector and going with the top 3 stocks. If you look at the oil, gas, consumable fuels, Reliance, Indian Oil, and ONGC. If you look at, for example, fast moving consumer goods, FMCG, ITC, Hindustan Unilever, Nestle India, Telecom, Airtel, Indus Towers, Bharti Hexacom. If you look at auto, Mahindra and Mahindra, Maruti Suzuki, Tata Motors. So it's only picking the leaders and building this index. And if you look at the total number of stocks in this particular index, it is around 61. It could vary, right? This is as of September 2025. 61 stocks is what it includes. In Sensex, we only have 30. Here you're getting 61, which is slightly more, slightly better diversification is what you're getting. And this is how this index is constructed. So which are the top 10 stocks in this particular index as of now? So if you look at this data, you will see Bharti Airtel, Reliance, HDFC. All 3 are having around 5% because 5% is the maximum a stock can get here. This is another rule that this particular index follows so that there is not a huge concentration on one particular index. If you look at Nifty 50, for example, HDFC has around 13%, right? So there is a lot of dependency on HDFC, one single stock. Here it is not the case. 5% is the cap, and you can see the top 10 here, right? All the leaders is what it has included. If you look at the valuations, PE ratio, PB ratio, very much similar to what BSE 500 has. Slightly elevated than BSE 500, but all in all, it is in the same lines. It's not like it's coming at a PE of, let's say, 30. Then I would understand that the valuations are very high. So I've given you a lot of details about this particular index. It's not at all a push that you invest in this particular index, but hope you learned something new. And if you genuinely learned something new, hit the like button in this video. Let me know in the comments a simple thank you. It motivates me to bring such content for you at zero cost, and you continue to learn, right? With that, let's move to index number 2. The second index is BSE Capital Markets and Insurance Index. Again, if you have not heard about this index, please don't worry. Allow me 2 to 3 minutes of time and I'll simplify this. This one is a thematic index, meaning capital markets and insurance is a theme that you are investing in. And if you think that capital markets and insurance in India are going to do good, then you take a bet in this particular theme, otherwise don't. And this is only for aggressive investors because it is highly concentrated towards capital markets and insurance stocks, right? Now this index is a fairly new index, launched in 9th October 2024. Only 1 year of launch, but in terms of calculating the returns, it has been based on 18th of June 2018. So almost we have got 7 years of data to look at. Now, first of all, let's compare the returns with Sensex. For example, have a look at 3 years annualized returns. This particular index has given 25.27% annual returns compared to Sensex, which has only given 13.56% total returns. So almost 2x the returns than Sensex in the last 3 years. If you look at the last 5 years, not a huge difference, 19.79 versus 18.06, only 1% or slightly more than that is what the returns are. This is because in the last 3 years, capital market and insurance related stocks have done really good. Why? Because a lot of people have joined stock market. A lot of trading is happening in India. A lot of people are going for insurance because of awareness. And these two themes are having a long runway even from here on. If I give you my opinion, again, this is just my opinion, you do some more research and I'll also show you some data in just a minute. But coming back to the risk now. So these returns we have seen very good returns in the last 3 years. What about the risk? If you look at the volatility or if you look at the standard deviation of this one, this is highly volatile as compared to BSE Sensex 30. For example, here the volatility last 1 year 20.87%, 3 years 18.50%, 5 year 18.61% versus BSE Sensex 12.34%, 12.21%, 13.40%. So this one is more volatile, standard deviation is higher, but at the same time last 3 years it has given better returns. Better returns does not mean that in the future also it will give you better returns. It depends on how does this theme actually perform in the next few years. Now let me break this index further down for you. If you look at the allocation, capital market related stocks have around 46% of total allocation in this particular index. This data is as of September 2025. Insurance related stocks has slightly higher, 53%, but these allocations could vary from time to time as the index gets rebalanced. Now if I show you some example stocks, so for example, let's talk about the capital market, which is around 47%. This is the last year's data, October 2024, slightly old data, but you get a gist of it, right? AMC stocks, for example, HDFC, AMC, Nippon, all these are around 15%. Stock broking stocks like Angel One, 361, etc. You've got exchanges, for example, MCX is there, depositories. If you've got financial products, for example, Anand Rathi Wealth. So we've got these capital market related stocks. Within insurance, you have two categories, life insurance related stocks like HDFC Life, SBI Life. Again, these stocks could change, right? Their allocation could change. But the idea is life insurance has got slightly higher allocation. General insurance has got around 15%. So in my view, this is a good roundup in terms of the capital market and insurance related stocks. If you think that this particular theme is likely to play out in the, let's say, next 5, 10 years or 15 years. And as of October 2025, these are the top 10 stocks. As you can see, SBI Life Insurance, ICICI General Insurance, MCX. You've got HDFC Life Insurance again, HDFC Asset Management Company, Max Financial Services. So you've got these stock weightages as well. Around 10 stocks is what you see on my screen. Now, the reason capital market and insurance sector is growing at a very, very fast rate, we all know what is happening in India, right? After COVID. A lot of people are consuming content. They are getting aware about the insurance products. They are getting aware about the stock market, mutual funds. For example, this video, my intent is to educate you, and it is up to you to decide whether you want to invest. Apart from FDs, you want to invest in mutual funds, index funds, stocks or not, right? In fact, on this channel, I've created a lot of videos around mutual funds, stocks. If you're new to my channel, hit the subscribe button. You're going to learn a lot. That's what my intent has been. Coming back, if you look at the capital market, some of the data, right? This data again is going back to September 2024, slightly older data. Data may change slightly here and there, but if you look at this, every day, more than 3 crore trades were executed, right? If you look at the new Demat account, close to 1 lakh Demats account getting opened every single day. It might slow down slowly, but the overall CAGR growth, if you see for Demat account, it's still going to be huge because India is still under penetrated when it comes to Demat accounts, right? So a lot of trading might happen, right? If you look at insurance, for example, have a look at this data, again, slightly old data, but 13 lakh new policies in one single day. You and me did not have insurance potentially 15 years back, or our parents did not have. We had a ULIP plan or whatnot. But now everybody is consciously choosing for life insurance, health insurance, and new policies are being written. So look at this data. The huge growth is likely to be there in the insurance sector. In my view, again, that's my opinion. You might do some research, might come up with something different. So overall, if you are bullish about capital market and insurance theme, then this index is good. Simply Google whatever index I'm talking about. Simply Google, you will find the ETFs, you will find the index funds. If you find multiple, just do a comparison of basic things like expense ratio, tracking error. I've talked about some of those parameters on my channel. Watch some of those videos. You will learn how to go about comparing the index funds. But this is the second index I really want you to learn about. Speaking about learning, if you want to learn about various assets, for example, mutual funds, stocks, gold, silver, precious metal, and other things, then you can consider joining my YouTube community. Almost on a daily basis, I'm posting exclusive content only for members. The feedback of this community has been excellent, and you are going to practically learn from each other as well. Simply go to my channel, find the join button and be my guest. With that, let's move to index number 3, which is Nifty India New Age Consumption Index. And this index contains 75 new age stocks. What are these new age stocks, Rahul? New age stock is a stock or a company that is catering to discretionary spending or aspirational spending. Something that you aspire to, right? That's what the spending is all about here. Can I give you examples? Of course. Have a look at these 10 companies. These are the top 10 companies in this particular index as of now. And if you look at Titan, for example, what does Titan sell? Jewelry, watches, all of these are aspirational products. If you look at, for example, Mahindra & Mahindra, what is it selling? SUVs primary, right? And that is an aspirational item. If you look at, for example, Eternal, which is Zomato, you and me are ordering from Zomato. It's quite discretionary spending, right? Although some people will argue that it is for the need, but anyways, let's park those discussions. Coming to companies like Eicher Motors, they are selling Royal Enfields, for example. So any company that is selling products that are discretionary in nature, which are aspirational in nature, they get included in this particular index. Now let me speak about the returns of this particular index. If you look at the last 10 years or 7 years, very similar returns as compared to Nifty India Consumption Index, another index that you must be aware about, right? If you don't know about that, let me know in the comments, I'll create another video. Nifty 50, Nifty 500, if you compare this one, very similar return profile in the last 10 years or 7 years. But now note the short-term returns, 3 years or 5 years, much better. 5 years, 28% versus 21%, 21%, 24%. 3 years, 29%, 22%, 18%, 22%. So clearly in the last 3 to 5 years, Nifty India New Age Consumption Index has performed better. Why? Simply because Indians' habits are changing now. Can I prove it by some data? Of course. Have a look at my screen. What you note is back in 1990s, we used to spend around 48% of our expenses in food. Come to 2024, it has reduced to 39% only. And we are spending now on healthcare, it has gone up. Rents, of course, because of inflation and many other reasons. Alcohol and tobacco has gone up. Consumer services gone up. If you look at, for example, education, we're spending more on that. Entertainment, we're spending on more. Point is simple that we are moving our expenses from food category to non-food as well now. So we are spending more money on the discretionary items, aspirational items, which are not basic needs. And this is why potentially these indexes are performing well in the last few years. And why is this happening? Mainly because of digital penetration. If you look at this data, for example, access to internet back in 2020, 58% of our population had access to internet, but now 70%. Going forward, it will further go up. If you look at the smartphone users, 38% to 59% almost, right? If you look at the online service users, from 22% to 52%. And this trend, in my view, will continue to grow up. And therefore, the consumption in India, discretionary spending, is likely to go up. And I've done a lot of podcasts, and a lot of mutual fund managers, AMCs, have been telling me exactly the same thing, that the discretionary spending in India is increasing day by day because of these reasons. And also, India is likely to become third largest economy over the next few years. I don't know when it will be. And when that happens, people are likely to have more money in their pockets. They're likely to spend more on discretionary items. There is nothing wrong in it. So hopefully the theme should do better in coming years as well. That's what my personal opinion is. Don't take this as a recommendation. Do some research about this particular index at your end. Now coming to how many industries this particular index caters to, almost 24 on your screen. Consumption does not just mean food items or FMCG companies. Consumption means everything that you consume. It could be, for example, airlines. You're buying an air ticket, that's a consumption. And therefore, it is highly diversified index, 24 industries. In fact, if I show you the stocks as of now, total 76 stocks that you see on my screen as of now, catering to various aspects in terms of industries and sectors. So very much diversified index that you see. Also, if I talk about a few other factors, the stock cap is 5%. No single stock can get allocation more than 5%. That's not the case in Nifty consumption. That's not the case with, for example, Sensex or Nifty, right? Sector cap is also there, 25%, right? If you look at the focus here, it is discretionary. If you look at the large cap, mid cap, small cap ratio, 60%, 28%, 10%. So quite a diversification already as per the market caps. While if you look at the Nifty consumption, 96% is large cap companies like Nestle, HUL. I mean, again, I've picked up some examples, but you get the point. It is much more diversified index. Now, if you want to go and invest in this particular index, just Google out the index funds that are there, ETFs that are there. Again, compare them and take your bets if you are good about new age consumption theme. My job here is to teach you about this particular index, learn about the returns, look at the risk, look at where the theme might go in the coming years. And hopefully this helps you as an investor. You become a better investor. You become an educated investor. That's the core intent with which I'm presenting you all of this data. And if you're liking this so far, humble request to hit the like button. Let me know in the comments. Simple thank you. It motivates me a lot to do a lot of research for you and bring all of this content in a nicely packaged video. So with that, I've covered 3 indices in this particular video. Again, not a recommendation, but let me know in the comments which index out of these 3 you think is going to do better, let's say by 2030, and you would look to include in your portfolio. Let me know in the comments. Would love to read your comments. With that, I hope to see you in my next video. Until then, keep rocking.